Welcome to Trading Analysis. This is Lesson 5 of Module 1 in our Trading Fundamentals course. So far, we've talked about edge, decision-making, probabilities, and behavioral traps. Now we're going to cover something that confuses a lot of traders: flows and macro. Because somewhere along the way, traders started treating every headline, economic report, and institutional flow as a trading signal. And that's where things get dangerous. Let me paint a picture. A trader wakes up, checks Twitter, checks Bloomberg, checks YouTube, checks 5 different market experts, and suddenly sees institutions are buying, rate cuts are coming, smart money is positioning, markets are bullish. Perfect. So he buys immediately. No chart analysis, no setup, no confirmation, just vibes and headlines. 2 hours later, he stopped out. Now he's confused. But the macro was bullish. Exactly. And that's the mistake. Macro can provide context. It does not provide entries. Weather forecast versus windshield. Think about it this way. Imagine you're driving somewhere. The weather forecast says it's sunny. Great, useful information. But if there's a truck stopped directly in front of your car, are you just going to keep driving because the forecast was bullish? Of course not. The forecast gives context. Your windshield tells you what to do right now. Trading works the same way. Macro is the forecast. Price action is the windshield. And far too many traders are trading the forecast instead of what's actually happening. Why traders misuse macro? Most traders love certainty, and macro sounds smart, talking about interest rates, central banks, institutional flows, ETF inflows, economic data. It feels professional. The problem? Many traders use macro to justify trades they already wanted to take. The market drops. Temporary pullback. Market drops again. Still bullish long term. Drops again. Institutions are accumulating. At some point, you're not analyzing anymore. You're just arguing with the chart. And trust me, the chart usually wins. The traffic light framework. Here's a much better way to think about macro. Treat it like a traffic light. Green light. Macro supports bullish conditions. Yellow light. Mixed signals. Be cautious. Red light. Macro creates headwinds. Be defensive. Notice something important? The traffic light does not tell you where to turn. It does not tell you when to enter. It does not tell you where your stop loss goes. It simply gives context. That's its job. What professionals actually do. Professional traders rarely take a trade because of one headline. Instead, they ask, what is the broader environment? What are institutions likely doing? What does macro suggest? Then they go back to the chart. Because at the end of the day, price still has the final vote. Not Twitter, not YouTube, not the guy with 20 arrows on his thumbnail. Price, the solution. Use macro to build context, not conviction. Use flows to understand the environment, not to force trades. And most importantly, always wait for price to confirm your idea. Because the market doesn't care how smart your macro thesis sounds. It only cares about supply and demand. Key takeaway. If there's one thing I want you to remember from this lesson, it's this. Flows and macro can help explain the market, but they should never replace the market. Use them as context, not signals. Because the best traders combine macro understanding with actual price action. And that's where real decision-making happens. In the next lesson, we're going to explore how to evaluate trading content, spotting funnels. Because not every trading video, course, influencer, or guru is trying to make you a better trader. Some are trying to sell you something, and learning how to spot the difference can save you a lot of time, money, and frustration. I'll see you in the next lesson.
Goodbye!